Welcome back to Investing Talk Podcast.
Today we're looking at Bitfarms. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We've got quite a bit to unpack here with Bitfarms.
Yeah, it's a fascinating one. A big Bitcoin miner, but trying this. Well, this huge strategic pivot, right, into AI and HPC.
Exactly. And the sources, the analyst consensus leans towards strong buy, but there's a lot under the surface. The mission today is really to figure out if that rating holds up against the risks, especially the dilution risk.
Okay, let's start with the basics. Where do they stand right now financially? They're a big player in mining, we know that. That TTM revenue figure, $245.66 million, sounds pretty substantial.
It is. It shows the scale of their mining operations. Trailing 12 months, $245 million plus. That's serious revenue.
But revenue isn't profit, and that's where things get a bit murky.
Murky is a good word for it. The profitability picture, looking at that TTM net income, it's negative. We're talking negative $86.2 million.
Ouch. So EPS, earnings per share, is also negative.
Yep, negative 17 TTM. And for, traditional investors, seeing red on the bottom line like that is, well, it's a major flag.
Right. Now, we know some of that reflects the market, doesn't it? Bitcoin prices were down earlier in 24, and they mentioned unexpected energy cost hikes, too.
Exactly. Those are real factors in this sector. It's volatile, but the losses are still there. So the big question is, why the strong buy? What are analysts seeing past these current losses?
We must be looking ahead then.
Completely. The bet isn't really on 2024's mining results. It's all about the strategic pivot, the shift into high-performance computing, HPC, and AI infrastructure.
And that's centered around the Panther Creek campus in Pennsylvania.
Primarily, yes. That's the flagship project for this transformation. It's not just a side hustle. They're aiming to align directly with these massive U.S. data center trends.
Okay, help connect the dots for people maybe less familiar. Why is a Bitcoin mining facility suddenly useful for AI? Isn't it just full of specialized mining rigs?
It's less about the rigs and almost entirely about the infrastructure supporting them. Think power and real estate.
Power, right. Mining uses tons of electricity.
Exactly. Bitfarms, like other miners, has spent years locking down locations with access to huge amounts of cheap power. We're talking hundreds of megawatts.
Yeah.
And they built the cooling systems needed to handle all the heat those miners generate.
Okay. And AI needs massive power and cooling, too.
Precisely. For those big GPU clusters that AI runs on, building a new data center site with that kind of power capacity from scratch takes years, huge investment. Repurposing a mining site, especially one that already has cheap power contracts, that's a shortcut, a big competitive advantage.
So they're leveraging the money they already spent on building mining infrastructure, the sunk cost to jump into a market, HPC and AI, where the margins could be much, much higher.
That's the plan. But like you said, building out that AI capacity, even on an existing site, needs serious cash. And that leads us to the debt.
Yeah, the capital raise. They took on quite a bit, didn't they?
They did. There was that recent $300 million convertible senior notes issue due 2031. And that came after an earlier, even larger deal, $588 million in notes that brought in about $568 million cash.
Wow. So combined, that's close to $1 billion raised.
Roughly, yeah. So what that means for you, the investor, is liquidity is strong. They have the cash buffer to fund this expansion and ride out market bumps.
But it's not free money. Convertible notes.
Yeah.
Let's focus on that. Why that structure? Why not just sell more stock now?
Good question. Well, convertible debt usually carries a lower interest rate than straight debt. Plus, selling that many shares outright now would likely hammer the stock price.
So they delay the dilution hit.
Kind of. The idea is the debt converts into stock later, potentially at a much higher share price if the whole AI pivot actually works out.
Yeah.
But, and this is the big but,
when those notes convert, it creates a flood of new shares.
Exactly, which dilutes the ownership stake of everyone holding shares before the conversion. Your slice of the pie gets smaller, even if the pie itself is hopefully bigger.
So that dilution isn't just a possibility. It's baked into the structure. If the company succeeds and the stock price rises enough for conversion to happen.
Precisely. You're basically trading that future dilution risk for the immediate cash they need now to build the AI infrastructure.
And the company seems serious about managing this. They brought in a new CFO, Jonathan Mir.
Yeah, and his background seems tailor-made for this capital markets, strategic finance. It signals they understand this isn't just about mining operations anymore. It's about managing nearly $1 billion in capital for a major strategic shift. His job is basically to make this U.S. pivot work financially.
Okay, and speaking of making it work,
Mm-hmm.
there are rumors swirling, right, about a potential partnership.
Oh, yes. The hyperscaler rumor. That's the potential game changer.
Like one of the big cloud giants.
Exactly. If Bitfarms could announce a deal, say, pre-leasing a big chunk of capacity at Panther Creek to a Google, a Microsoft, an Amazon, someone like that.
That would be huge validation.
Instantly, it would prove their concept that they can actually sell this repurposed mining infrastructure as high-value AI capacity. It shifts the narrative from them being just a Bitcoin price proxy to being a premium infrastructure provider. That news could move the stock way faster than any jump in Bitcoin.
Makes sense. Now, thinking about their position even before this AI push, they had geographic diversity as a strength, right? Canada, US, Paraguay, Argentina.
They did, and that helped with resilience, especially accessing different power markets, but they're pulling back from Argentina now, exiting by November 2025.
Why shed operations if they were established, maybe had cheap power? Seems counterintuitive.
It's about focus. Where are the highest returns likely to be? Right now, the bet is clearly on North American HPC. Managing those more distant sites adds complexity, geopolitical risk, operational hurdles.
So consolidating.
Yeah, consolidating focus and capital on the big potential plays, like Panther Creek in the U.S. It streamlines things and frees up resources specifically for this high-margin AI opportunity. It's basically admitting the future isn't just about mining hash rate, it's about selling power capacity.
Okay, let's talk timing. Because with a stock this volatile, timing feels critical. There's a big catalyst right around the corner. Q3 earnings on November 13th.
Absolutely. The market is watching that date closely. We've already seen Bitcoin prices and, importantly, transaction fees pick up in Q4, which should help the Q3 numbers they report on the 13th.
And other miners have seen rallies after earnings recently.
Yeah, the sector has seen positive reactions to earnings beats, so a beat could give Bitfarms some nice short-term momentum. But honestly, the numbers themselves might be secondary.
To what? The commentary.
Exactly. What investors really need to hear from management on that call are concrete updates.
Like what specifically? What are the key things they need to deliver?
Two things, mainly. First, real details on how that new $300 million is being deployed. Are there new sites confirmed? Specific timelines for hardware expansion at Panther Creek? Or the dream scenario, confirmation of that hyperscaler partnership we talked about.
Okay, deployment updates. What's the second?
Clarity on how the new CFO is integrating and driving the strategy. Any sign that they're moving fast, turning that cash into actual working AI infrastructure, that's what will really move the needle. Proof of execution.
Right, execution is key.
Yeah.
Let's look at the stock price itself. As of November 1st, it's around $3.90. But that doesn't tell the whole story, does it? The volatility.
Oh, it's wild. The 52-week range is insane. From 67 cents up to $6.60.
Wow. That range basically charts the whole crypto sentiment swing, doesn't it?
Perfectly. From peak pessimism near 67 cents during the crypto winter to peak hype around the halving and this AI pivot hitting $6.60. It is absolutely not a stock for the faint of heart.
But where does it stand technically right now?
Well, the trend lately has been more positive. It's been holding above its 50-day and 200-day moving averages. Technically, that suggests some underlying bullish momentum in the medium term.
And the RSI, the Relative Strength Index, it measures momentum speed.
It's sitting around 51.29, which is pretty neutral.
So not overbought yet.
Exactly. It suggests there's still potentially room for upside, like if they deliver on earnings or announce that big deal without hitting a technical ceiling immediately. There's capacity for more buying, technically speaking.
And the analyst price targets reflect this high-risk, high-reward setup too, right? The average is around $3.83, but some are way higher.
Yeah, that average target is actually slightly below the current price, interestingly. But you have those outliers calling for $7.
And that $7 target is basically the AI pivot works perfectly scenario.
Absolutely. It fully buys into the thesis. Top-line growth potential, operational resilience from their setup, and successfully capturing this huge shift into AI infrastructure.
So boiling it down for someone listening,
Yeah.
the core decision is really about your time frame and risk tolerance.
I think so. Are you playing for a short-term pop based on the upcoming earnings? Or maybe some quick news on expansion that's more of a trader's view?
Or are you investing for the long haul, believing in this structural shift to AI, and you're willing to accept that significant dilution risk that comes with the convertible notes.
That's the fundamental choice right now. You have to weigh that dilution, which is almost a certainty if they succeed, against the potential multi-bagger return if they pull off this transformation into an AI data center player.
It all comes back to execution then.
It really does. Their future value isn't just about how many Bitcoin they mine anymore. It's about how fast and how well they turn that nearly $1 billion they raised into tangible, operational, and crucially, contracted AI infrastructure. That's the metric to watch.
Okay, here's a final thought to leave folks with. If Bitfarms, or companies like them, successfully manage this hybrid model, leveraging their power infrastructure for both Bitcoin mining and AI hosting, could this become the standard playbook? Could we see a future where large-scale energy infrastructure inherently doubles as computing infrastructure, fundamentally changing how we think about both? Something to consider.